$121 a barrel. And when the US Federal Reserve looks set to raise interest rates later on today, 0.75% increase is in the market already. But I wonder if they will surprise us by going higher, especially against the backdrop of soaring inflation, crashing markets. The consensus, according to Bloomberg this morning, is for that 75 basis points. But some people, Bill Ackman in particular, is calling for a full 100 basis points, followed by another one next July. And Jeffrey Gundlach apparently urged the Fed to put in a full 3% increase this time round. So I want, first of all, to quickly go round my guests here today and get their instant impression. I want to feel the mood in the room on this, on Fed rises, to answer the question, will the action that the Fed is contemplating taking today get inflation down without sparking a recession later this year or early next? Let's go first to Daniel Richards, economist for the Middle East region at Emirates MBD. Daniel, give me your snap verdict on that, if you would, please.
Yeah, so I think we were still holding to our view for a 50 basis point rise rather than a 75. Obviously, the chances of that coming in much higher, and the markets do seem to be swinging that way now. So maybe 40% probability of that we're now seeing. But our expectation rather is that they do a series of 50s, maybe do another 50 in September rather than a two, as we previously anticipated. Then of course, you've got the QT, the tightening, quantitative tightening and rollback of the asset sheet as well, which can be speeded up as well, of course. But whether they manage to engineer this soft landing is looking like an increasingly arduous task, I think, for the FOMC. They are going to have to go more aggressively than they had planned, whether it's 75 basis points today or not. It will be more aggressive than we had expected. And we're already seeing pretty weak data coming out of the US, not least for consumer confidence index last Friday, which fell to a series low since 1952.
Okay, let's go to Rafik Latta, senior correspondent for Energy Intelligence based in Cyprus. Rafik, hello. Give me your take on that, would you?
Yeah, well, I haven't got a really independent view on what they're going to do today or this week, but I would say that something that's been underappreciated is just how the chances, the outlook for something not going to plan, and geopolitics and Ukraine shaping Fed policy. I don't particularly see whatever they do today is going to have a massive increase on massive impact on prices per se, oil prices per se, although right. Hopefully it will do something on inflation, which I don't know about you in Dubai, but we're certainly feeling it here. I mean, I went out to my favorite restaurant the other day and boom, 20% rise in prices.
Yeah. We're certainly feeling it here as well. The world is feeling it, I believe. Yeah.
Hopefully, it will be able to eat away at that. But I think this core kind of oil and gas price, I think structurally, there's just lots of reasons why it's going to stay strong as long as the war and the policies being used to combat Russia are as they are. I just don't really see, barring a massive slip or some really big resurgence in COVID, kind of this underlying driver behind inflation, i.e. Energy complex sort of easing much.
Okay, we will talk in detail about oil markets just a bit later, but let me get Robin Mills, the view of Robin Mills, CEO of Kamar Energy and a well-known contributor to this show. Robin, you are in Tbilisi in Georgia, I believe, rather than your usual UAE. The question that I'm trying to get some kind of response to is what will the Fed do today, and whatever it does, will it be enough?
Well, I think we're expecting a little bit of tightening, of course. That's the general kind of expectation. Will it be enough? You know, I was just reading a very interesting look back on the 1970s inflation, you know, Nixon and then Jimmy Carter. And that made the point that, you know, the politicians were always hoping for a positive surprise, hoping things would turn out well. They didn't have to tighten as much as the economists said they would, because that was politically damaging in a high unemployment and so on, and a potential recession. And so they always erred on the side of not tightening enough. And the Fed, of course, wasn't as independent in those days, but the Fed got the message that don't tighten too much, and misread the situation. So we've had a year, even a year and a half or so of that kind of caution so far, or that underappreciation of the effect of inflation. And inflation is a new thing to most policymakers, right? There's not many policymakers who really remember the 70s inflation anymore.
That's right. Yeah,
and so it's been allowed to kind of run away.
Yeah. Okay. We'll come back to this question towards the end of the show, but let's move on to oil. And I'll stay with you, Robin, for a while. Oil at 121 this morning, up a shade. At this kind of level, some people are talking about the imminent prospect of demand destruction. Are we beginning to see that? Where would we first see the signs of demand destruction? What should we be looking for?
I think what's interesting here is that crude prices are not that high, actually. Historically speaking, $120 odd a barrel. The record, of course, as we know, was 147, but inflation adjusted, that's more like 170 today's money. So we're nowhere near that. But the end user prices are very high. They're at records. I mean, petrol and diesel prices. And that's because the refining complex is so stretched. And that means the end user prices absolutely are in demand destruction territory. So we should watch the price sensitive consumers. We should look at places like India, because that's where you will see demand destruction first. And I think we are indeed already seeing signs of that. We'll see the agencies, starting to revise down their demand totals, but they'll always be behind the curve, of course. So we really have to look for signals in these price-sensitive consumers. Don't think we're actually seeing that demand destruction much in Europe or the US much, but we are starting to see.
We're not seeing it yet, you mean, but it will come.
At these price levels, I think it's inevitable. It will come, absolutely.
Right. Okay. Rafik, there is an interesting little item on our News Digest today about people in Pakistan being asked to drink less tea to help the Pakistani economy. And I'm wondering whether this is the kind of demand destruction that we'll be witnessing soon. But tell me, from your perspective there in Cyprus, what's the outlook for oil prices and for this spectre, if you like, of demand destruction?
Yeah, well, I don't disagree with Robin. I mean, it looks like product prices are certainly going to ease somewhat. But on the crude side, like I said, I think it's going to take quite a lot to really take some steam out of it. And let's not forget, prices would be a lot higher if it wasn't for the SPR release, which is playing a key role. To what, throw a dart at it, but no doubt they would be a lot higher than they are now if it wasn't for that. And the longer it goes on, the less efficacy it will have. There's a limit you can play this game.
Right.
And, I just think it's going to take a lot. It's going to take a lot for the steam to come out. I mean, really, there is a problem with global capacity. You look at OPEC, their production actually went down last month.
Sure. What about the prospect of further prolonged lockdowns in China? Is that the kind of thing that will take the steam out, as you say?
Yeah, I mean, look, certainly prices could go like $10 either way, but I just don't really see it. It's going to take something really big. My view. I mean, that big could well be coming. There's no doubt about it. If the world goes into recession, we'll be in big territory. But it's going to need that. I personally think. So there's no doubt another China lockdown will take some heat out of it. But I do note that they've increased the buying and they're taking a lot of Russian stuff. And so I do think there's a slight disconnect between possibly between the economic activity or the GDP growth and the oil price.
Right.
We haven't seen in the past.
Daniel, Goldman Sachs going for $150. What's the Emirates NBD view?
Yeah, so our year-end forecast is 115. So we've got 120 average Q3, and then coming off a little bit at the end of the year to 115. But as the other two guys were saying, it really dependent on these massive exogenous factors. You know, we've got the war in Ukraine. How is that going to go? How long will Western economies stick with these sanctions? Will they buckle, or some start to buckle in the face of the cost of living crises in various countries? Will China go back into big lockdown or come out? So obviously there are massive variables this year to a kind of level I think maybe we haven't seen for some time, pandemic barring, of course.
Okay. Robin, we had confirmed today that President Biden will be visiting Saudi Arabia and meeting with Mohammed bin Salman, the Crown Prince, and also with other GCC countries, including the UAE. Let's have a talk about this. Is there anything that he can pull out of the hat here? Can he offer Saudi Arabia, the UAE, something to drag them away from Russia?
Well, this meeting's been a bit of a saga itself, right? Oh, I'm going in June. No, I'm going in July. Yeah, I'm going, but I'm not going to talk about energy really. Yeah, I'm going, but I'm not going to Saudi. I'm just going to meet for the GCC meeting really. So there's been a lot of attempts to kind of obfuscate this meeting. But in terms of what he get, look, he can offer a lot, no doubt. I mean, the US obviously has plenty to offer on the defense side and some diplomatic issues and so on, personal ones and higher level ones as well. So no doubt he can offer a lot. What can he get in return in terms of relief in oil prices? Well, Saudi kind of threw him a bone with the OPEC decision to accelerate the production increases, but that's pretty trivial.
A very
really.
small bone.
Yeah. I mean, that's the least that they could do just to show they're actually trying to do something, but of no real practical effect. So what else could they do? Yeah, I mean, Saudi and the UAE could put up to 3 million barrels a day, between them back on the market.
Have they the capacity to do that?
I think
3 million.
Perhaps not instantly, but within a kind of 90-day period, they could get up to 3 million, 3 million extra. But does that really help? I mean, firstly, of course, that means kind of busting the OPEC Plus framework. Although you could say after August you need a new framework anyway, because the quotas will have been, or the cuts will have been worked off by then. But then we have the refining constraints. So if there isn't capacity to refine the 3 million barrels per day, bearing in mind that global crude stocks have actually started creeping up again, would extra crude production really help in this case? Maybe around the margins, diesel-rich crude, helping put more diesel on the market, but structurally that you've got to get around the refining constraints as well.
Biden is talking about boosting up the US refining industry as well, isn't he? Rafik, what do you think? What can he pull out of the hat? There was some talk about him swapping guarantees on security, even an Arabian NATO as an alliance against Iran, more progress on Israel, opening up relations with Gulf countries. What do you think he can get?
Look, we've heard that he could get quite a lot. I don't think it's going to happen. I think Israel domestically, the situation between them and the Palestinians is a bit too febrile for something big breakthrough to happen. I could be wrong.
So you mean in terms of Saudi re-establishing, or rather establishing relations with Israel? Yeah.
In Jerusalem, and domestically, it's certainly in danger territory for MBS were he to announce some big breakthrough on the Israel front. So I don't think it'll happen. But what I do think is underappreciated is that, leaving aside US pressure and US appeals, I suspect the Saudis, if they had any sense, will be shifting their view on Russia, not in terms of their long-term commitment to the alliance, but I think in terms of their view on what the war is damaging to oil prices and demand destruction. I think that if they got any sense, and they do, they will be concerned about a recession, and I think they would see it more to their advantage than they did a couple of months ago for this war to come to an end sooner rather than later, and that's going to lead prices to go down and Putin to come under a bit of pressure. and as well, that also helps the demand destruction side. So
Yeah.
I suspect they're more likely to be flexible, more likely to be flexible than they were a couple of months ago to US appeals, no matter what the change in US policy will be, which I suspect Biden, his personality, it's taken a long time to come around to this. It's been very grudging. It smells of something that he's holding his nose while he's doing this. And this
he's been pushed into it, hasn't he?
Yeah.
And there are lots of people in the administration and the Democrats who really don't like this idea at all.
I think globally there's been a complete failure to appreciate on a consumer and a West side, the impact of what being a producer means, and the geopolitical impact, either whether it be Russia or Saudi Arabia. You can say what you want, and take whatever, make any whatever rhetorical points you want, or theoretical sanctions. But at the end of the day, it's the people who've got the oil who've got quite a lot of muscle.
Yeah. Daniel, tell me, how do the banks or the economists indeed view OPEC Plus? Because we're now in a situation where many members of OPEC Plus can't fulfill their quotas, not least Russia. Is it a viable economic organization anymore?
Yeah, I mean, you have to question that, don't you? And even the production curbs are being eased, but half of them aren't meeting their quotas. And then as well, the language, I mean, obviously there's always been a lot of obfuscation about language coming out of OPEC or OPEC Plus, but making only these very vague and veiled references, whether that be to situation in Russia or a situation with China. And you just think it's hard to see how they can't offer more clarity on that if they're going to be successful, if they're going to make meaningful decisions. I think there has to be a bit more openness to be more viable, and to look at the agreements more frequently as well, perhaps, because clearly this OPEC Plus agreement as it stands seems to have gone past its sell-by date in many ways, whether that's what's happening in Eastern Europe or just people not missing their targets generally. So I think they will be having to relook at that over the next few months and decide what is the more beneficial course of action for them, whether it's as OPEC or OPEC Plus.
Right. Robin, its actual sell-by date is coming up sometime soon, isn't it? The production agreement is supposed to end at the end of this year. Give me a view on what might replace the current OPEC Plus setup.
Yeah, it's a bit of a problem, isn't it? Because now the production cuts will be completely phased out by the end of August, but the deal itself runs until December. Now,
that's right.
That can't mean that they're going to just leave production flat until December and then think again, because clearly production ought to keep rising. So there'll have to be some kind of post August, some new agreement on production increases. Now, as we know, only Saudi and UAE, perhaps Iraq a little bit, can increase. So that'll mean everybody else either gets granted notional increases that they can't make, and then the target becomes more and more of a fiction, or there's some complete realignment of quotas and people are given kind of realistic baselines that they can actually hit, and that allows those who can to increase production. But that's going to be very controversial because, of course, everyone will argue for higher quotas than they can actually meet. And in particular, Russia will be a sticking point. Russia will say, well, look, I was given 11 million baseline and I can produce that. Okay, no, I find sanctions may be stopping me doing that temporarily, but in principle, I can produce that. So that's again it's going to be a very, very difficult conversation. But there has to be some kind of continuing mechanism for production increases. Otherwise, Saudi and UAE will have to say, well, guys, the deal has done its job, and now everyone's just back to producing as you can or as you wish.
Right. Let's talk about gas for a moment. Rafik, there were two quite interesting items in the news today: the Freeport LNG terminal explosion in Texas, and also Russia cutting flows through Nord Stream 1, 40% down, blaming it on sanctions, of course. How significant are these events in terms of European gas supplies?
Yeah, well, so very significant in terms of short-term stuff, and Europe needs to build up stocks ahead of this winter. If this war is still going on, but come winter, I've said it before, Russia is going to play games. It's going to exploit. It's going to exploit that economic weakness. If I was an EU policymaker, I'd be very worried about the winter. I think there's another point to be made is just how the Ukraine war has completely altered the outlook for LNG and security, energy security, full stop. And I think we're going to see a lot more project approvals, debottlenecking, investment, short-term FSRU type of projects. Certainly in Europe, there's been a lot of activity. The Germans have just okayed some 3 billion of finance to expand their import capacity for LNG. This isn't going to happen in time for the winter.
Right.
For long term, LNG is a very good bet for expansion. And I think, a couple of years ago, everyone was wondering whether there was a need for new projects, or certainly the supply outlook was outpacing demand. And now it's a complete flip side.
Right.
Yeah.
Putin said recently, didn't he, that just yesterday, I believe, in an interview in Moscow, that it would take Europe years to wean itself off dependence on Russian oil and gas, and that he'd be raking in the profits for years to come. What do you think of that prospect, Daniel?
Yeah, well, obviously that's risk they're playing, and obviously that's going to become a much more harder thing to deal with over the next several years if this cost of living crisis doesn't abate. We have got already the risk of households struggling to either heat or eat, and the longer this goes on for, the greater political pressure there might come on governments to make some kind of accommodation. I don't think we're really seeing that as yet. I don't think there's a big groundswell of opinion leaning that direction in most of the big European economies, at least. But when people are potentially struggling to stay warm or to go hungry, then that might start to switch, especially if that goes on for, as Putin's saying, potentially years.
Do you think that there's an enthusiasm in Europe to suffer on Ukraine's behalf? Will people take the pain in order to support the campaign against Russia in Ukraine?
Yeah, exactly. It's very hard to say when it starts to materially affect you, right? Everybody's supportive of them in principle, but when it comes to that kind of big impact on their incomes, on the squeeze, and we saw in the UK, for instance, the wage data yesterday, the real wage growth was far below what it had been for decades, I think. So as that continues to squeeze households, then that impetus, that will to be supportive of the conflict will necessarily, I think, sadly or not, start to dissipate.
Robin, there was a big deal yesterday announced, Qatar, Total Energy, on Qatar's northeast field. What's the significance of that, and how does it fit into the European gas puzzle at the moment?
Yeah, so obviously, Total getting the 25% share of one of the trains, expecting some further announcements in the next few days of other partners. You'd expect Exxon and Shell and Conoco to be in the mix, possibly others. Obviously, while this expansion is enormously important, of course, if there's going to be this kind of replacement of Russian gas into Europe with LNG, then Qatar's the only country, along with the US, that can make a significant contribution to that. Others will chip in bits and pieces. The expansion's coming, 2020, 2026, 27. So this is not an immediate panacea, but by any means. I think it's more significant. Look, Qatar was going ahead with the expansion anyway. It's got the capital. It knows how to do this now. These partners were not essential. I think the expansion is already well underway. It's more significant for them, really, that they need the LNG position. And that's why they're all competing so hotly for it. Essential for their LNG portfolios.
Rafik, anything to add on that? You're a gas expert.
Yeah, I think first of all that it's probably going to. I think we're more likely to see a fast track on decisions of further expansions. So there's this big 32 million tons a year that phase one that Total's got a stake in, and there's another 16 coming straight after it. And then we've probably got at least another train on that they've been working on. I think that we're going to see an announcement, a final investment decision there. I think it's worth noting that this transition terms, that this is like it's a bold new breed project. This is the greenest LNG we've ever seen. So it's got, CCS, carbon capture, it's got solarization of utilities. And that is why they're bidding so hotly for it. And probably why Total won, because it is the most aggressive major in terms of advantage oil and gas. That's its transition strategy, and it's got a bolt on. It's supplying some of the solar for
okay.
Yeah.
I want to move back to financial markets and economics towards the end, if I can. Can we pull up the survey question, please? Because I'd like to get a feel from the people who are listening to us of what they think on the question that I put to you guys earlier on. The Fed rate rises are coming too late to head off a further significant inflation surge and will only help push the US and other big economies into recession. And it's a single choice. Either you agree or you disagree. So let's get a view on that, please. Thank you. We'll hear the results soon. Daniel, the world is looking a pretty uncertain place in terms of economics and financial markets. But the region, the GCC, is looking pretty good. It's kind of a safe haven. Some people have called it the only investable markets in the world. IPO booms, stock markets are off a little recently, but nowhere near like the rest of the world. What do you think might happen to upset regional markets? Are they vulnerable? Regional economies, are they vulnerable when the rest of the world appears to be heading downwards?
Yeah, so on a growth or headline GDP growth perspective, at least, we're pretty positive on the region this year. 5.7 is our forecast for GDP growth in UAE, 7.7 KSA. A lot of that, though, is being driven by the uptick in oil production. So we've got 13% forecast for oil sector growth in Saudi Arabia. On a non-oil side, though, it's still holding up comparatively well compared to much of the rest of the world. For UAE, for instance, we expect 4% growth. And that's one of the reasons is inflation hasn't been to quite the same degree here as seen elsewhere for a variety of reasons. It is hitting people increasingly, and everyone's experience of inflation is different. But on the aggregate, it isn't really to a level seen elsewhere.
What's your inflation figure for Saudi and UAE by year end?
So 4.5% for UAE. I haven't got KSA off the top of my head, but when you compare to what we're seeing US, Europe, UK, etc.
Yeah, it's half of what. Half of what's going on.
Oil prices are ticking up. Transport has been the key driver of headline inflation so far. House prices, for the time being, still haven't started coming into play. That's a bit of a laggard on the CPI. They will start to come in down the line, but then you would expect some of those other pressures from the oil price, from food prices, might have started to tip through the base. So keeping that the headline general level a bit lower than it has been elsewhere. The one risk, I guess, would be a strong dollar does pose a threat to exports generally, and higher interest rates could be a curb on activity. But when you compare the region, even on the non-oil sector basis, to the rest of the world, I think it's looking pretty strong.
But of course, they have to follow the Fed on interest rates, don't they? Robin, you're an expert on the economics of the region too. What do you think? Are we safe here? Sorry, you are in Georgia, I know, but are we safe here in the UAE?
Yeah, look, there'll be some measure of imported inflation. We see it on fuel prices and so on. We'll see it on food and so on, no doubt. But the energy side, I mean, the energy earnings are extremely strong. So, the economy is going to do very well overall. And that benefits most people. If you're working in the energy sector, if you're working in real estate sector, consumer goods, all these kind of things should do very well as long as the oil earnings keep coming. And the region's not immune from a global recession, oil price slump, whatever that may come down the line. But for now, the outlook is about as good or better in the Gulf than almost anywhere else in the world.
Yeah, absolutely. Can we pull up the survey result, please, just to see what the rest of the room thinks? Right, that's overwhelming. 90% believe that the Fed's action is coming too late, and that we are being pushed towards a recession, both in the US and other big economies in the world. That's pretty conclusive. Let me get a final word from Rafik. Does that surprise you? Such a strength of opinion there.
No, I think everyone's jittery, aren't they? Yeah, you look pretty much everywhere, and while short-term prospects, there's a bit of disagreement on when this recession will happen. There's pretty much consensus that it will. That we're in for a rocky, bumpy ride ahead. Yeah. If there's one more thing I'd like to say, go back to that OPEC question about relevance. Short term, I agree they've got some difficult decisions. There might be some challenges to unity. They might look ineffective. But long term, this organisation is going to be relevant. They will make themselves relevant because they have to. Without a market management system that has a certain amount of credibility, certainly when prices are low, the region loses geopolitical relevance, and its economies die.
Right.
So they will make it work long term.
Okay. And we have a new Secretary General coming in. Is it next month, I believe?
Yeah. Pretty interesting. I have to say, Barkindo has been brilliant for the organisation. Come COVID, the guy was a machine. A real dynamo. He made that. He was a big part. Clearly, it's the Saudis and the big producers who drive it, but he was also a big part of that COVID response that was so successful.
Yeah, I think most people would agree with that, and he's a nice fellow too.
It's nice to have a Secretary General who quotes Shakespeare at you.
Yeah. He's a very eloquent man. Okay, well, look, the three of you, Robin Mills, Rafik Latta, Daniel Richards, thank you very much indeed for your contributions today. I think that was really interesting. It's a big day. There's a big week coming up. There's a big week every week. But we'll be back again to discuss what's forthcoming. Thanks a lot for your involvement.